When it comes to long-term investing, you really don't need 15 different funds doing similar things. If your goal is to grow wealth over decades, one solid, globally diversified ETF can often do the job and do it very well. So let's break down the 4 most popular global ETFs available to UK investors and figure out which one really deserves a place at the core of your long-term portfolio. First up, let's talk about Vanguard's VWRP. If you're looking for a simple, all-in-one way to invest in a global stock market, and then pretty much forget about it, the Vanguard FTSE All World ETF is a great option. It's the kind of fund you could buy once and not think about it for years. Ideal for long-term passive investor. VWRP tracks the FTSE All World Index, which gives you exposure to a broad mix of developed and emerging markets in one go. That means you're investing in companies from almost 50 countries, from the US and Europe to fast-growing economies like China, India, and Brazil. Altogether, the fund holds almost 3,600 stocks, so you're getting wide diversification straight away. Some of the top names in the portfolio include Apple, Microsoft, Amazon, Nvidia, and so on, which means you're getting a solid slice of the world's tech giants along with thousands of others. Also, around 10% of the fund is invested in emerging markets, which adds an extra layer of diversification without the need to manage separate holdings. Importantly, this is a physically replicating ETF, meaning it actually buys the underlying shares rather than using derivatives, something many investors see as more transparent. Now, since its launch back in July 2019, the fund has performed strongly, returning around 70% so far. That growth has helped push the fund size to over £16.6 billion, which shows just how much investor confidence is gained. VWRP is also an accumulating ETF, so any dividends it earns are automatically reinvested. A great feature if you're aiming for long-term growth. And with ongoing fees of just 0.22% per year, it's still relatively low cost for something this broad and globally diversified. So this fund is all about simplicity and wide coverage. You're not trying to guess which region will do best. You're buying a slice of the entire investable world and letting global capitalism do the heavy lifting. With exposure to thousands of companies, you're extremely well diversified. That said, it's the most expensive of the 4 in this comparison. But at 0.22% is still very reasonable. And really, you're paying for full global exposure, including emerging markets, plus the peace of mind that comes with Vanguard's solid reputation. Next up, we've got iShares Core MSCI World, often referred to by its ticker SWDA. This one's a go-to choice for investors who want broad global exposure, but with a focus purely on developed markets. SWDA tracks the MSCI World Index, which means you're getting exposure to over 1,350 companies across 23 developed countries. Places like the US, UK, Japan, France, and Germany, and so on. So while you're missing out on fast-growing regions like India or Brazil, you're heavily invested in the world's most established economies. Some of the big names in the fund are familiar ones: Apple, Microsoft, Amazon, and so on. Many of the same global giants you would find in VWRP. The key difference here is the exclusion of emerging markets, which makes the fund slightly more concentrated, but also a bit less volatile. Now, SWDA is also a physically replicating ETF, so it holds the actual shares rather than relying on swaps or synthetic exposure. It's an accumulating fund too, ideal if you're looking to grow your investment over the long term. It's been around a while, launched back in September 2009, which means it's got a solid track record behind it. And speaking of that track record, its performance has been impressive, returning around 449% since inception. That's the power of compounding over time, especially when you stick with it through the ups and downs. The fund has also grown into a bit of a giant, with a size of over £78 billion. It's one of the biggest ETFs in Europe. That scale tends to bring tight spreads and plenty of liquidity, which is great for investors. As for costs, the ongoing charge is just 0.20% per year, so it's marginally cheaper than VWRP. That said, you're giving up emerging market exposure in exchange, which might be fine depending on your view of global growth and your risk preferences. Overall, SWDA is a great choice if you want developed market exposure in a simple, low-cost wrapper. It's reliable, it's efficient, and it's backed by iShares, one of the most trusted ETF providers in the world. It's cost-effective, super liquid, and gives you exposure to many of the same big companies you would find in a broader global fund, just without the potential drag or volatility of emerging markets. The main downside, no emerging markets, which might be a drawback if you're aiming for full global coverage. While emerging markets don't always outperform, they can add valuable diversification and potentially a performance boost over the long run. Bottom line is, SWDA is solid, simple, and slightly cheaper than its broader rivals. If you're happy to skip emerging markets or plan to add them separately, this is a strong long-term option to anchor your portfolio. Next on the list is the Invesco FTSE All World ETF, which goes by the ticker FWRG. If you like the idea of a broad global fund like VWRP, but are keen to keep costs as low as possible, this one is a great alternative. It tracks the same FTSE All World Index, so you're getting exposure to a wide range of companies across both developed and emerging markets. That means you're investing in over 2,400 stocks from nearly 50 countries. A good chunk smaller than VWRP's nearly 3,600 holdings, but still offering solid diversification across different regions and sectors. You'll find the usual suspects in there, big global companies, including those tech giants, making it a fairly familiar mix for investors who want a global slice of the market. FWRG is also an accumulating ETF, which means dividends are automatically reinvested, and it also uses physical replication. Now, one thing to note is that it's quite a new fund. It only launched in June 2023, so while it's had a decent start, returning about 29% since inception, it doesn't have the long track record of some of the other funds on this list. The fund is still relatively small, with assets of just over £1.1 billion, which means it's a lot younger and less established than giants like VWRP or SWDA. But it's growing, and that size can be a good thing if you're looking for something more nimble or willing to back a newer player. What really stands out here is the expense ratio of just 0.15% per year. That's cheaper than both VWRP and SWDA, making it one of the most cost-efficient ways to get global exposure with emerging markets included. So why might investors pick FWRG? Well, it's simple: low fees, broad diversification, and the convenience of a physically replicating accumulating ETF. The trade-off is the shorter track record and smaller fund size, but if you're comfortable with that, it could be a strong contender for a long-term holding. Rounding out the list is the SPDR MSCI All Country World ETF, or just ACWI for short. If you want broad global coverage, including both developed and emerging markets, but at an even lower cost than the other options, ACWI is definitely worth considering. This ETF tracks the MSCI All Country World Index, giving you exposure to over 2,200 companies from around 50 countries. So it's slightly less diversified than VWRP in terms of holdings, but still offers a very wide spread across regions and sectors. ACWI is also physically replicating and accumulating ETF. It's been around since May 2011, so it has a decent track record under its belt, delivering a strong total return of about 301% since inception, a testament to steady growth over time. The fund currently manages assets of around £3.3 billion, making it mid-sized compared to some of the giants on the list. That means it's reasonably liquid, which is helpful if you're looking to buy or sell without too much fuss. And probably the most attractive feature here is its very low fee of just 0.12% per year, cheaper than VWRP, SWDA, and even FWRG. So you're getting solid global exposure at a bargain price. So why is ACWI a strong option? Well, this ETF gives you full global exposure for almost half the fee of VWRP. If you're after a single global fund, want to keep costs down, and don't mind whether you're tracking the FTSE or MSCI index, ACWI is a very strong contender. It might not have quite as many holdings as the likes of VWRP, but it offers a cost-efficient way to invest globally over the long term. To wrap things up, here is a quick look at how these four global ETFs stack up. VWRP is your all-in-one, no-fuss option, offering huge diversification with nearly 3,600 stocks across almost 50 countries, including about 10% in emerging markets. It's reliable and has a solid track record, but it comes with a higher fee of 0.22%. SWDA skips emerging markets, focusing solely on developed economies. That makes it a bit less volatile and slightly cheaper at 0.20%. And it's a strong choice if you prefer to add emerging markets separately or want a simple, lower risk core holding. FWRG gives you a similar broad mix to VWRP, but at an even lower cost, just 0.15% per year. It's newer and smaller, so it doesn't have the long track record or size of the others yet, but it's a compelling, cost-efficient option for investors happy to back a newer fund. Finally, ACWI delivers full global coverage at the lowest cost here, with a fee of just 0.12%. It has fewer holdings than VWRP, mostly due to the different index it tracks, but performance is broadly comparable. It's a great pick if you want ultra low fees and solid diversification in one neat package. Each has its own strengths, and it really depends on what you value most in your portfolio. If you found this breakdown helpful, don't forget to like and subscribe. And check out this video next to find out if a global ETF is actually the way to go, or if you should focus on the S&P 500 only, given that it makes up over 60% of a global fund. See you there.